Before we talk about our tech stock, capital light, and Wide-Moat portfolios, let's look at what happened recently and what's coming up this week. Last week, the Federal Reserve's preferred inflation gauge came in higher than expected. That, plus additional tariffs, this time a 25% tariff on vehicles and vehicle parts, increased the market's worry about future inflation. And many expect reciprocal tariffs to be announced on April 2nd. Morgan Stanley said if permanent, the announced auto tariffs might add 20 to 30 basis points to inflation this year. If inflation remains a problem, it means interest rates will likely stay higher for longer and company earnings will be lower than expected. The result was the market fell 1.45% this week and tech stocks fell 3.28%. Let's talk about next week. On Wednesday, the president will give an update on tariffs, and it's expected that reciprocal tariffs will be announced. So it could be more volatility ahead next week. And on Friday, we'll get unemployment data in the form of the non-farm payroll report. This will have a big impact on the possibility of the Federal Reserve changing interest rates. And remember, we would love to have the Federal Reserve lower interest rates, which will make mortgages cheaper and borrowing money cheaper. It'd be great for the economy. Now we continue to be in a market correction. The S&P 500 has fallen 9.4% from recent highs and at one point was down 10.1%, putting us in a correction. Tech stocks have fallen 15.1% as measured by the most widely traded diversified tech ETF, which has a ticker symbol XLK, and dividend-paying stocks as measured by ticker symbol SCHD have fallen 7.2%. Studies show that dividend-paying stocks outperform non-dividend-paying stocks, especially in down markets. Now, our two dividend stock portfolios have fallen about half the amount of the S&P 500, with our high-yield portfolio doing the better of the two, since it has much less allocated to the tech sector. We talked about our dividend portfolios in last week's video, and we'll probably talk about them more in next week's video. According to the Center for Financial Research and Analysis, since 1990, the market has had 12 declines in the range of 10% to 19.9%. So these are called corrections. In the following 6 months after the corrections, S&P 500 rose an average of 22%, and the three sectors that fell the most during the correction rose an average of 27%. This could be good news for tech stocks. Of course, we don't know if the market correction stays within the 19.9% mark or if it falls more than 20% from recent highs, which would officially make it a bear market. That's when stock prices become a huge bargain. During declines preceding all recessions, the S&P 500 fell an average of 28% since World War II. The average recovery time of recessions is 18 months, meaning you would have 18 months of buying opportunity on average to buy stocks at much cheaper prices. So take advantages of corrections and bear markets. So here's our user disclaimer. The presentation is for informational purposes only and is not a recommendation to buy or sell securities or engage in any investment activity. It's all well and fine to get investment ideas from others, but you always need to do your own research. With all the uncertainty over inflation and tariffs, one thing is for certain. Stocks are a much better bargain than they were just a month ago, especially tech stocks. So let's talk about the tech stocks we bought at the beginning of last week. On this slide are our ratings for the top 15 tech stocks as of last Monday. I posted these rankings to our website, beatthestockmarket.com, last Monday. Then we purchased the top 10 stocks. We list 15 just for some additional information in case you want to explore and research stocks further than just the top 10. Note that all these stocks are higher quality, meaning they must have a quality ranking of B- or better. More on what makes up our quality grade on the next slide. Also note that the ranking system used for these tech stocks may differ from the rankings we use to rate dividend growth stocks because some tech stocks do not pay dividends. Therefore, in this ranking, we ignore the criteria that involves dividend growth, dividend payout ratio, etc. Our highest rated tech stocks last week were Adobe, Taiwan Semi, Applied Materials, Microsoft, ServiceNow, Arista Networks, Analog Devices, NVIDIA, Synopsys, and NXP Semi. On this slide, I want to show the components to our quality grade. Quality-wise, we only invest in stocks rated B- or better for this portfolio. Risk is the first quality component. Tech stocks, by their very nature, tend to be riskier than most other sectors. The next quality component is competitive advantage. Obviously, the more competitive advantages a company has, the better investment candidate they are. The next quality component attempts to evaluate the company's management. Our evaluation includes both management's use of capital in general decision making, but also our research dives deep into accounting data to look for red flags in the company's accounting practices, as well as the quality or reliability of their reported profits. And finally, the last quality component is financial health. Remember that the risk rating here is comparing these stocks to other stocks, not to other investments like bonds or CDs. Now, one reason why tech companies have been outperforming for the last decade or so might be because they tend to require little capital. As a simplified example, if you want to start a software company, you just need a computer and software knowledge. On the other hand, if you want to start manufacturing cars or jets, you're going to need a lot of buildings, a lot of equipment, a lot of employees, etc. In other words, a lot of capital, which is very expensive to obtain and maintain. Now, Goldman Sachs recently published a research note that shows that companies that do not require a lot of capital have significantly outperformed companies that employ heavy capital during the period of 1990 to 2024, and it's not even close. The research calculated capital intensity based on three formulas: assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. We find this research to be very intriguing and have come up with a way to see which companies currently require little capital, are of high quality, seem to be undervalued, and therefore look to be great potential investments. But first, let's just look at a list of the S&P 500 companies that are considered capital light according to the Goldman Sachs study. Once again, the formulas the Goldman Sachs study used were assets divided by number of employees, assets divided by net income, and capital expenditures divided by net income. So these are really easy formulas that you can do in Excel on your own. And since the study covered a 34-year period when growth outperformed value, on this slide, just for fun, I added our valuation column, which in this case is based solely on a growth methodology instead of our usual combination of two methodologies, one being growth and the other being deep value. So on this slide, I now have the list of what I consider to be the best high-quality capital-light companies. The previous slide, it just showed which ones had the least capital intensity. So on this slide, I have a list of S&P 500 companies that are capital-light, high-quality, which is this column over here, and appear to be undervalued using a growth methodology. Here's what we believe their undervalued amount is. So far, the strategy is ahead of the S&P 500, but it's very early in using this strategy. Now, the Goldman Sachs study didn't specifically state what constitutes a capital-light company other than the three formulas. In other words, did the study deem half of the companies to be capital-light and the other half to be capital-intensive? I'm not sure, as I have not found more details of the study. If any of you can find those details, please share them with the rest of us. I chose to consider the companies with a rank of capital intensity from 0 to 30% to be considered capital light. So for this slide, I started with a list of over 4,300 companies, and the first step was to filter out the companies that were capital intensive. I deemed that the company had to be in the first deciles to be capital light. In other words, they had to be in the first 30% of companies when ranked from least capital intensive to most capital intensive. I then filtered out all stocks not in the S&P 500. Then I ranked them based on a combination of our quality grade and their valuation. And on this slide, we have the top 15 companies. The top 10 are Chipotle, Applied Materials, Adobe, Arista Networks, Hubble, MSCI, NVIDIA, Nike, Accenture, and Eaton Corp. Now let's talk about our wide moat strategy. This is a strategy I started tinkering with behind the scenes in September of 2023. It's not the most diversified portfolio, so I decided to wait longer to share the results. It's a wide moat stock strategy. First of all, what is a moat? M-O-A-T. Well, Morningstar is a service that rates stocks and is famous for its moat rating that it assigns to large companies. What is the moat rating? A moat rating attempts to simply measure the competitive advantages of a company. If a company has no competitive advantages, then it's very easy for another company to enter the industry and take customers away from that company. They call it a moat rating because they liken it to a moat around a castle. If the moat is wide, and that's the best rating, then it's hard to storm the castle. If the moat is narrow, then it's easier to attack the castle. And if there is no moat at all, then the castle is much easier to attack. So this strategy invests only in the companies with the best competitive advantages, in other words, the widest moats. There are limitations to the moat rating, and I prefer my own quality ranking system that takes much more data into consideration along with the moat rating. But the moat rating is kind of a quick shortcut way to invest in high quality stocks. On the next slide, you'll see my rankings of the top 15 companies with wide moats. But first, let's look at the strategy's performance. Like the tech stock portfolio, I've been making weekly investments into this portfolio. I originally had this strategy in a Fidelity portfolio with a few other strategies, but quickly learned that having several strategies in the same account makes it a nightmare to track their performance separately. So I sold off those holdings and have since started a Fidelity account dedicated solely to this wide moat strategy. The average investment so far has been held for less than a year and has produced a total return of 21.19%. Using Excel's rate function, that's an annual return of 44.58%. Now, the strategy does not result in a portfolio with as much diversification as most of our other strategies, so the portfolio's performance could fluctuate a lot. Morningstar offers an ETF that only invests in wide-moat stocks, so that ETF is a natural benchmark for the strategy. Its ticker symbol is, not surprisingly, MOAT, MOAT. If we'd instead invested in MOAT on the same exact days, we would have received a total return of 10.64% instead of 21.19%. With the same holding period. Using Excel's rate function, that's an annual return of 21.4%. Now, our strategy is also beating the S&P 500 by 16.31 percentage points on an annualized basis. So basically, it's kicking the market's butt so far. Now let's look at our list of best wide moat companies. In other words, the companies with the strongest competitive advantages. These ratings are as of last Friday after the market closed. The valuation methodology used here is a growth methodology, not a deep value methodology. Our highest rated companies in the wide moat strategy are Arista Networks, ServiceNow, Constellation Brands, NVIDIA, Adobe, American Express, Chipotle, Marriott, Hubble, Applied Materials, Amazon, Broadcom, Alphabet, also called Google, Salesforce, and then the other Alphabet stock, which has a ticker symbol of GOOG instead of GOOGL. There's not a whole lot of difference except for voting rights in those two. So in the comments, let me know if you have any questions, and also let me know what portfolios or investment strategies you'd like to see more of. And finally, here are the places you can reach me. YouTube, obviously, as well as our website, beatthestockmarket.com, LinkedIn, and Twitter. I'll see you again next weekend, likely with a list of dividend stocks we'll have purchased on Monday. See ya.